I would say, Varinder, just to give clarity, that it was the Reliance team which identified the pharma sector, and it was not Madhu Kela alone. And Sailesh was actually the backbone. We were all the front heroes. He was the real producer of the movie at that point of time. So we all worked very, very closely, and of course we made a lot of money for our investors. The fund went 50, 100x in that time frame of 15 years. So fantastic period. So just wanted to clarify that. Just coming back, Manoj, it is a very, having said that, it's a very, very complex business. It is not simple. And which is why a lot of people are also very apprehensive in investing in pharmaceutical sector. So because you have worked in a company, you have worked with one of the largest and most respected broking house, and also now you are on the fund side. So can you give us, Silas explained the industry, what is the framework which one must use to invest in the pharma sector? What is it which one must look when you look for a company to invest in? And what is one must avoid in a pharma company, where we should make up your mind that this is not a long-term bet and we should not look at this company? Manoj.
Sure. Thanks, Madhu, for that question. And thank you, Sailesh, sir. I think Sailesh has explained this whole construct very beautifully. So if you look at the way we look at and the way we approach to the sector, is basically, I think from a construct perspective, we broadly classify the sector from whether, you're looking at a company from a formulation perspective to the API. So the first construct or first screen which we focus upon, we prefer a company which has more formulation than the API business. And within the formulation, we look at the company which have more focus on the branded generics, or so-called like India and emerging market kind of business than to the generics. And within branded generics, we look at the company which have more focus on the chronic segment. So-called chronic, as again, I think Sailesh has beautifully, explained that while we are a developing country, but having a problem of developed countries. So India today is the world capital of diabetes. We have the second highest number of cases for the hypertension. So the company which have more focus on the chronic side of the portfolio, particularly like cardio, diabetes, CNS, and there obviously is likely to be more stickiness and more longevity of the growth. So we prefer companies which are more focused on the chronic side of the portfolio versus the acute portfolio. And similar kind of screen or the construct we would like to run even for the emerging markets, because the business what we do in India and emerging market are not very different. So that's obviously the first way to look at in terms of while you are identifying the companies. On the US side, when we look at the company, I think there are 2 or 3 key parameters and critical, qualities which we look at in the companies. One is in terms of the vertical integration, because if you look at in the US, what is the only constant factor? The price has to come down. So obviously you have an ability to have the most cost-efficient manufacturing processes, though that's not the only variable part, from a US perspective. And the second is that the Indian companies are now moving up the curve from a commodity kind of a generic business to maybe more complex kind of business profile. You need to have an R&D capabilities as well as the balance sheet kind of strength. So I would just like to put up a point out here that when today you look at the generic market in the US, it's almost around $35 to $40 billion market at a manufacturing price. Half of that market is the commodity market, where Indian companies have been able to garner 40 to 50% kind of market share. But unfortunately, the balance 50% of the market, which is so-called complex, such as maybe respiratory, transdermals, injectables, you can call maybe ophthal and derm out there also, then the Indian company's market share is only 15 to 20%. And that is something where I think Indian companies they were going on the right path. In the last 4 or 5 years, they were investing in terms of incremental R&D. They were investing in terms of building the capex. But unfortunately, because of the supply side consolidations and maybe the regulatory issues, the Indian company had got a setback in the last 2 or 3 years in the US market. But that doesn't mean that probably the path which they have taken, they're going to stop that. And that's where we are very, very constructive that Indian generic days in the US has yet, while we have become the global manufacturing hub, probably we are the largest volume manufacturer in the world. But when it looks in terms of the complexity of that business, Indian companies will see the incremental innovation going forward, and that's the path which I would say is going in the right direction.
So, I just want to, at this point of time, pause for maybe 10 seconds because, and make one important point that all of us have agreed to devote this time, which is very valuable for everyone. And we want this session not to be an entertainment session, that we had another session and we discussed some pharmaceutical industry and 4 people came and gave some gyan. So be it. So we want absolute key takeaways to be noted as to what is the conclusion which we are driving, what are the conclusions these experts are driving. So, and people who spend 20, 25, 30 years are giving, and make a proper note of that, whoever is viewing this session, so that it can actually make an impact on your investing in style and on your wealth. That is the whole purpose. The purpose is not to give gyan. There is enough gyan and knowledge which is available on internet. It is for us to take a key takeaways. Mentioned 2 important points. Just to summarize, one, he said that in a company, we look at chronic diseases, which is very long-lasting portfolio and can deliver consistent return over a period of time. And second, he mentioned that the specialty pharma, specialty product portfolio which we got into, we have had some setback in the last 2-3 years, but the story is not yet over, and there are promising future for the companies which are there in the specialty field. Manoj, did I miss anything?
No, fair enough. I think you have summed it very well, Madhu.
Fantastic. Anmol, you were a guy, you are the person who actually cautioned the world about the pharma industry well in advance. Essentially, I think you wrote a report somewhere in 2014-15 to be cautious on the pharma sector. And of course, after that, the pharma industry in the stock market definitely suffered a setback, and a lot of the pharma companies didn't do well. So if you can just explain what was your thesis then and what has changed for you to be bullish today. Yeah. And I hear that you're bullish now.
Yeah. Thanks, Madhu. Thanks for that question. See, the question is that, obviously pharma sector, thanks to you guys and bringing it to the fore, Shailesh said that, pharma doesn't get the prominence, but I must make a disclaimer, but for you and Shailesh, it would even be under the radar. It's now widely understood and widely respected. But there are 2-3 things which kind of, the complexity of the sector prevent people from understanding. One is that competency build-up takes time, right? And once companies have built up certain competencies, it's only then that they are able to monetize and commercialize the competencies that they have built. And we in the market at times are either ahead of the curve or behind the curve in terms of what's happening on the ground and what the lead and lag times can be in terms of commercialization of these successes. See, in 2015, the thesis was fairly simple.
Sorry, Anmol.
If you look at top 4 Indian...
Anmol, I just want to pause for a minute. You make a very important point that in the pharma sector, unlike other businesses, the competency, if you set up a cement plant, it is up and running in 2 years. But in a pharma sector, the competencies take a long time to build. Even a normal plant, US FDA plant takes 3, 4, 5 years to get product approved. It's a very important point that it takes time to build competencies. Hence, there are huge entry barriers to this sector.
Absolutely.
Is that the right thing to conclude? So this
Absolutely.
is one of the key takeaways.
Yeah, absolutely. So competency build-up takes time, and then to deliver on that in terms of profitability, there is another journey. We in the market tend to kind of, are either ahead of the curve or behind the curve in being able to recognize this. In 2015, the thesis was fairly simple. So if you looked at top 4 companies and the multiples they were getting, the US revenues they had, the implied growth that they had to deliver in next 3 years was a product launch calendar in excess of $3 billion. And this is just for top 4 companies. And when we did our bottom-up math, we were very clear that this is not going to happen. If you have stocks trading at 30x, US top line is 2 billion, 1.5 billion, there is an inherent growth which is implied in the earnings multiple or any other valuation metric from which you look at these companies. We were quite convinced that it is not going to happen. The ask rate for these companies to deliver was too high. So similarly, if you went back around 9 months back or 12 months back and became extremely, took a fresh look and used the same parameters to look at the sector, what you would discover is that, the ask rate for these companies to surprise on the upside is very limited. There is a period of 4 or 5 years which has passed. These companies have invested meaningfully in this, in R&D pipelines, competency build up, tried to evolve their game. And therefore, what the market or the valuations are expecting for them is fairly modest. And given the quality that these companies have exhibited through the cycle, that shouldn't be very hard for them to achieve. So that became, the construct for turning that, look, a lot of price damage is done. And, you are looking at now probably the next leg of evolution of Indian pharmaceutical industry, where these guys have done all the hard work required for 3-4 years and are obviously as a part of their evolution, ready to move to the next stage.
So what is the kind of...
Anmol, I'll pause you for a minute. Varinder, this is a very important point.
Yes.
He mentioned the ask rate in 2014-15 had become very unsustainable, and ask rate now has a potential to surprise in the upside, and the ask rate is not very high at this point of time. Again, I'm pausing and making sure that the people get relevant input to think about the pharma sector going forward. And I repeat again, it should not be an entertainment session. So this is again key takeaways.
So Anmol, one thing I just want to ask you. So what is the kind of ask rate right now? You said CapEx has happened in the last 4-5 years and the ask rate is low. Last time it was $3 billion you mentioned in 2015. At present?
So, this $3 billion was a number for top 4 companies. You'll have to do it for next sector. But there are 2 things that I highlight. So one of the banes of the sector for the last 3-4 years is, you would have heard this, is pricing erosion, right? So pricing erosion in the US, if you look at 15 years data, and I'm not talking, which should cover around 3 cycles. If you look at 15 years data, the median number for that is 7%. So now if your median number is 7%, then you would obviously have a range which is like 4 to 11%, and that's the range for last 15 years. What happened for the Indian pharma sector was that when the pricing erosion was 4%, you also had a dollar which was appreciating or rupee which was depreciating. And when you had 11%, you also had a couple of years, 15, 16, when you actually in your Indian rupee appreciated against the dollar by 3-4%. So a range of 4 to 11% from an Indian company's top line reported perspective started looking like -1-2% to 15-16%. So that was how wide the range was. Of course, there were industry specific factors, like there was buyer consolidation in the US, they had more leverage, etc. But I think clearly now the needle is swinging to the other side. At this point of time, the evidence is largely anecdotal, but we'll see that strengthen in the days to come. That courtesy your rupee depreciation and some kind of stability in the US market, the pricing in the US or the challenge for the Indian companies is stabilizing. So they will obviously launch products. Their FDA plants have come through, and even 10-12%, given relative to where valuation and market expectations are, should be able to drive positive surprises. So that is what it is looking like at this point in time.
Sure. Aditya, can we in a similar manner get to you for your opening remarks and what do you think about the industry over the next 3 to 4 year time horizon?
So, Madhu sir, just to add, okay, I think Aditya is more bullish on the mid cap and small cap segment in the pharma space, and he
Sure.
has done very beautiful, research as well, and his Excel is all over Twitter as well, in which he compares the ROC of domestic companies and the international companies. So it'll be great to have his perspective also on the mid cap, small cap pharma companies, and also if you can highlight the MNC pharma companies and the kind of valuations they are trading in. What is your
Sure.
perspective?
Sure. Thanks for that. I agree with all the three experts who have commented so far, but I'll just add a little perspective to this. The challenge in pharma is that none of these pharma companies do only the domestic business or only the emerging market branded business that Manu sir spoke of. They don't do, most of them don't do only the domestic business that Shailesh sir spoke of, and most of them don't do only the export business that Anmol was talking about. An average pharma company in India does all of these businesses. And the challenge therefore becomes is, when you look at the numbers that the company reports, it reports one profit, one ROE, one top line. You don't know how much, they are making in exports, how much are they making in emerging markets, how much are they making in domestic. And you don't know what sort of return on capital employed is the company really making. What is the return on equity of the company? So there, you sort of need to do a self deep dive, maybe take guesstimates and understand what the company is making in the domestic market as an ROE, what the company is making in US as an ROE, what the company is making in emerging markets as an ROE. And when you value that company, when you value Reliance Industries, right, you don't take the EBITDA of Reliance Industries and give it a multiple. You don't take the EPS of Reliance Industries and give it a multiple, because you understand that they are in three very, very different businesses, right? But when you look at a pharma company, most people are more than happy to give a multiple to the reported EBITDA or reported PAT. But well, that's just not right, because in some of the businesses where they've invested 60-70% of their balance sheet, they are not making any EBITDA, they are not making any PAT. So how are you valuing them at that number? If you give a loss a multiple, so some of the mid and small cap pharma companies, and this is where I'm slightly bullish on their space versus the large cap space, some of the mid and small cap pharma companies on their US exposure or on their export exposure by and large don't make any significant profit, maybe even making losses. Now, if you give a loss of multiple, what you are telling me, mathematically speaking, is that not only will that loss remain a loss, the loss will actually grow as a loss for the next 20 years. That's what the multiple implies. Now, that's just not going to happen. No entrepreneur, no businessman is going to do a business for 20 years, which is going to give him growing losses, right? So two things can happen, right? One, he closes the business because he can't make it profitable for whatever reason. And two, he actually makes it profitable. So as an investor, in both cases, I make money. How much money do I make depends on his ability to either make it profitable or just shut it and say, enough is enough, I can't do this anymore, right? So what Varinder was alluding to is just a sort of an infographic which alluded to this. I just took a hypothetical example of a pharma company which had 50% sales coming from US, 30% sales coming from India, and 20% from emerging markets, API, and contract manufacturing. And I just took the average ROE that the sector does in these markets in times like these. And what we figured was that in the US the ROEs are really, really poor. And if you were to just strip out a pharma company, strip out the US business of a pharma company and then look at its balance sheet and P&L, it would look far closer to an FMCG company, as Shailesh sir was saying, than look as a low ROE business that it is alluded to be, right? So my simple point is, when you value conglomerates, value them as conglomerates. Don't look at them as a single businesses. And if you do that, you're just committing mathematical error.
Can you, Aditya, sorry, can you talk about any specific companies just to elaborate as you said, we have done extensive disclaimer already.
Sure.
Whatever you speak is not an invitation for anyone to buy or sell a stock. So can you just illustrate this point by speaking about a particular company?
I will, sir. So there is a stock called Ipca Laboratories. That's a company that Manoj sir has worked for already. And, we as DSP, we are, again, the disclaimer front, we as DSP, we are the largest institutional shareholders in Ipca as we speak today. So, sir, Ipca's FY14 EPS earnings per share was 42 rupees. Then they ran into this trouble of US FDA and UK MHRA, WHO. They actually got banned from all three regulatory agencies. And out of that 42 rupees, if I were to bifurcate into domestic EPS and export EPS, it would be about 30 rupees of domestic EPS back in FY14 and 12 rupees of export EPS back in FY14. Then, after these bans happened, and IPCA was trading at about 900 rupees, so a consolidated multiple of, let's say, about 22 times, right? Now, if you look at what happened to IPCA after these three bans came in, the consolidated EPS in FY16 for IPCA, after 2 years of FY14, FY16, IPCA's consolidated EPS was 6 rupees. Now, nothing changed in their domestic business. So that domestic business EPS should have ideally grown from 30 rupees, but let's assume it remained at 30 rupees. What happened to the export EPS? It actually went down from 12 rupees to minus 24 rupees. Sure. And from that perspective, IPCA stock fell down from 900 rupees to something like 300 rupees. And it was still looking expensive at 300 rupees because you're looking at a 6 rupee EPS. But that doesn't make sense, right? Because you have to understand that there is a 30 rupee domestic EPS standing there. Within that 6 rupees of EPS, there's a positive 30 rupees of EPS in domestic and a 24 rupee loss in exports. So if you give the loss on exports a multiple, you're committing a crime, mathematical crime. And, that's how we analyze the entire situation. And there are many
Aditya, you make a beautiful point. There's a point to be noted very well. See, this happens in pharma companies all the time.
Yes, it does.
It's not the only time this has happened. There are some few pharma companies which are going on even today.
Correct.
With the same.
So, Madhu sir, can you help us with one example in which companies do you see at current, these things happening? Will be helpful for all of us to learn.
So let us say, take for example even Sun Pharma. The way it is got valued today, some of the businesses are not making any money, but they have invested significant portion of capital. And like for instance, they have invested rest of the, I don't want to get into numbers out here, just to give an example. I think, Aditya, if you can throw some more light on Sun Pharma, if you have looked at it, in a similar manner, what happened to IPCA and where is Sun? And I would request Salesh to add, because I know it forms a large portion of his portfolio and he's very bullish on this company.
So Madhu sir, I'll just add, because I did some numbers on Sun. And Salesh sir, I think the 4 segments what you mentioned, I'm presuming that domestic branded pharma is the segment you are most bullish on out of domestic pharma, CRAMS and other hospitalities, diagnostics. The first question.
See, the domestic, you're referring to the domestic pharma piece, right? I mean, as the
domestic
the mood question is, Aditya raised a beautiful point that at the end of the day, pharma companies are getting valued, wherein a lot of the capital which has got invested because of the temporary regulatory issues, that capital somehow becomes unproductive and that part of the business actually makes losses, right? I believe this is happening in Sun right now. So can you just run us through to dissect it better and how to value a company like that?
So just to add, okay, Madhu sir, your perspective, Abbott, which is domestic, the market cap right now, Abbott is around 35,000 crore.
All pharma companies is similar, especially those who are operating in many markets, right? Some part of the business is doing well today, which is already profitable. Generally, the domestic business is generally profitable for a lot of Indian businesses because it's a FMCG of a business. The second business where normally challenges come is primarily the US regulatory businesses, US businesses, because that is where it requires a lot of capital. We have seen a few companies over the last 5-7 years try to address those markets and have invested. Some companies have invested large sums of money between $200 million to $1 billion, I mean, depending on the kind of their balance sheet capabilities. Why this investment in the specialty business by any Indian company is important is because this is the next level of growth for Indian entities. And 10 years back, this was not possible for any Indian company to do because they never had the resources and balance sheets to do it. Some of these tried to do in the most risky area of research within research and development, which has not played out so well. But now they are going a little later, closer to market and investing a lot of money there. And in my belief, most companies globally have become successful with one or two large products becoming their flagship billion-dollar products. We've seen larger companies, international companies, all of them which are very big names today, started off with few very good successes in 1980s and 90s. I think it is the time of Indian companies from a specialty business point of view. Maybe the leading businesses could in some manner take that leap and make investments there without worrying for the next 2 or 3 years in terms of how profitability will look like, and have the scope for expanding the reach of the market. For example, today, the US generic market, which is just about maybe $70-80 billion, but you have a large innovative market which is running into $500-600 billion, in which even if our companies get a small market share by investing capital there, we could create very large enterprises out of India. So directionally, in pharma, there are always businesses in gestation, which is the case in many companies today. And as this gestation phase for most of these companies comes to an end and these products become meaningful and contribute to profitability, the face of a lot of Indian pharma businesses might look very different from where they stand today.
Sure.
Okay.
At this point of time, Varinder, I want to make a few important points vis-a-vis the technicals of the pharma industry, vis-a-vis stock markets. A lot of these data may be known, but at the cost of repeating, I will repeat it because there is certain section of the people who feel that we have had a 50% rise in the pharma index. And you told me before we started the webinar that a lot of people are even telling you are too late to hold this webinar. And I must admit that in the last 1.5 months, I've seen it has become fashionable to talk about selling financials and buying into pharma sector. So where does the sector stand in terms of the real numbers? I'll just give some numbers. So as on 23rd March, the overall market cap of the pharma sector was 5,70,000 crores. This is mostly all listed companies put together. As things stand today, as of let's say yesterday, the overall market cap is close to 8 lakh crores. So we have clearly added 2,30,000 crore rupees of market cap in the from 23rd March till basically 25th May. So undoubtedly, it's been a big rise in this time frame. Now let us look at this whole thing historically. So in 2008, Varinder, when we started to talk about the pharma industry, the overall market cap was only 1,40,000 crores in 2008, April of 2008, right? In 2015, when we peaked out, which was timed with Anmol's report, virtually, the overall market cap went to 8,08,000 crores. So after 6 years, virtually, we have come back to the same market cap and what we were in 2015. So that is one very important point to be noted, right? So in spite of this rise, we have only come back to where we were in 2015. Now let us just go back to some weightages. So in 2009, the pharmaceutical weightage of the overall sector weightage was only 2.4%, right? At this point of time, like the technology had 13% weight, or banks and financials all put together had more than 25% weight. By 2015, again a very important event point because that is where the sector peaked out. By 2015, the weightage of healthcare had gone to 7.3%, right? And the overall weightage of things like financials and all had come down by in 2008. From 2008 till, by 2015. And by March of 2020, the weightage of pharma sector in the overall market cap was only 2.7%. So we were back to where we were in 2009 in terms of the sector weightage. And now if I look at the free float of free float weightage. Even as of May, which is 25th May, this weightage has gone to 3.3%, as compared with 2.8%, which was there by March March 31st March. So these are very, I would give a lot of weightage to this.
So you are saying that from the top, we are not even 50% of the total weightage.
That's right. They're not even 50% of the total weightage. And on the from a technical perspective, Varinder, this is where I want to share my experience. Whenever a sector will start to get re-rated or gets into radar of investors, there is a very high probability that it will end up in a bubble valuation zone. Whether now, what happened to financials in the last 10 years, a lot of smaller banks 1 year back went into, 5 times, 6 times, 7 times book value, which was unheard of. So I think if the pharma sector has started the re-rating exercise, it may be too premature or too early for people to conclude, because it has had a significant rise in last 2 months, and a lot of money definitely is being made in the last 2 months, but it might be premature to conclude that sector has done what it has to do. As I said, the weightage is still significantly lower, and in our part 2 of discussion with all of these eminent panelists, we will talk about the numbers and what it looks like over the next 2 years. But as I monitor a lot of pharma companies, we can see a lot of growth happening in a lot of mid-sized and even larger pharma companies in terms of earning over the next 2 years. It might be premature to conclude that pharma sector has done what it has to do. I do not think this sector this time will stop till the time we have bubble valuations. And forget bubble valuation, we are nowhere near even proper valuation. Lot of the pharma companies which I track are still available below 10 PE multiple, not EV EBITDA, 10 PE multiple if we look at a 2-3 year earning perspective.
Okay, got it. So I will love to hear those names of companies which are still below 10 times PE multiple from you later. But on this perspective, I want to get Anmol here. What happened in 2014-15, no one saw that event risk coming in. So, right now, of course, the US pricing pressure is coming down. A lot of capex has been done. Because of COVID, the demand is coming back. But the issue is that there is no event risk we are highlighting anywhere. The US elections are coming in. Like Madhu sir said that, there could be, we are nowhere near what we were at the top. As per you, Anmol, I think, what is the sustainable earnings valuations we should give to this sector? If I compare for the last 5 or 10 years, there is nothing cheap barring, 4 or 5 companies, which is Oro, Sun Pharma, Glenmark, or these names. But in terms of the entire sector, what are the kind of valuations you see are the right valuations to give to this sector, keeping the event risk in mind?
So, a couple of things. One is that if you look at valuations are on 2 sides. One is absolute and second is relative. On a relative basis, the pharma sector deserves to and has always traded at a 40% kind of premium to the broader indices. That has obviously come down in last 2.5-3 years. I think there is an absolute case of that actually happening, that these companies reclaim that premium relative to the broader market because of a host of positive factors that we just spoke about. In absolute terms, for companies, even in good times, leave alone bad, we have seen that there has been a big dispersion in terms of what different companies trade at, and which again is to Aditya's point earlier that these companies are not homogeneous in that sense. They do fairly different businesses with very different return profiles and margin profiles. So I think instead of pegging a absolute number to what the right valuation is, because the companies are fairly diverse, you look at more like sustainability of earnings and where you think there are likelihood of surprises, positive as well as negative. We've seen at peak these companies trade at 30-32 times elevated earnings, but the price damage or appreciation largely from a practitioner standpoint comes when there are surprises on your earnings front. Because 32 going to 24 will also be accompanied by a Sun Pharma's EPS of 48 turning to an eventual loss sometime 1.5 years back. So I think that process is synchronous. So I think that's what you have to bear in mind. Second point I want to...
Let me just add, do you think that there will be new leaders which will emerge now if we are seeing that this pharma or healthcare space will grow for the next 3-5 years and everyone will make money? So the new leadership will emerge from the mid-cap pharma companies growing to the large caps and the earlier leaders will not sustain? Is that the case?
So all I'll say is that leadership attributes will remain the same. Whether leaders are different, that still remains to be seen. But I think if you look at the evolving complexity of the sector, especially globally, and we all acknowledge that exports is an important part of the story. What happens is that the game is also becoming complex. It is involving higher compliance costs, adherence to quality standards. Balance sheet cannot be a disadvantage as you try to pursue this. So large companies have a head start by virtue of the base that they have. Incrementally, to demonstrate growth in revenue percentage terms will be harder. But I think when it comes to accessing opportunities, size is not actually a deterrent or a restraining factor for most of these companies. I think most of the large companies in India, if you look at what they've done in the last 3-4 years, exactly the period of time that stock markets haven't been too kind to them, have put in a lot of hard work. Men have been separated from boys. So, for example, Aditya took the example of Ipca Laboratories, trying to take out that loss, which was a part of their EPS, and therefore, doing all the right things. There have been instances when companies have not managed to do it. There have been instances like Wockhardt and Ranbaxy, which have not been able to do that. Right. So every incremental evolution for the Indian pharma industry will be accompanied by some players being left out and some trying to go to the next level. I won't use purely size, right, which would be your pharma, mid cap and large cap as a distinguishing factor. It would be management qualities. Two examples which got taken earlier on the panel, that the companies invested and then made sure that capital allocation leads to greater IRRs in whatever they were trying to pursue. Ipca and Sun Pharma, I would back them. But, there are instances which, without going into names, I know that, these companies will struggle because either they do not have the management quality or the bandwidth, or the ask rates, again, for them are too high relative to what they've invested in their capabilities.
Anmol, just taking your point forward, I just want to ask Manoj at this point of time that how do you differentiate in this kind of a scenario the point which Aditya made, that there are a pertinent period of time when companies lose money because of a particular event which happens, which is more regulatory in nature. So how do you differentiate which are those, which is a Sun Pharma or Ipca and not a Ranbaxy or a Wockhardt or any other company which has not worked out? That's point number one. Point number two, I made a lot of technical points which were very bullish, but as an investor, with a common sense and with only very little knowledge, any event risk which happens in a pharma company, like you have an inspection, regulatory inspection, which happens, and that it turns out to be negative, and in the stock market, we end up losing disproportionate amount of money. How will investor reconcile, and how should they assess, at what valuation to buy what?
Sure. So Madhu, again, I will go to the basic point. And the point is basically, as an investor, we would always look at a businesses from a bottom-up kind of an approach, rather than just having a top-down kind of, sectorial outlook. And when I talk about the bottom-up kind of approach, and as you indicated, maybe the previous instances, like the case of Ipca or Sun Pharma, I think the focus has to be in terms of the execution capabilities of the management and the historical track record. Many times what happens that we as an investor tends to respond maybe certain events which happens by accident. And like typically when you talk about in terms of US
Manoj, sorry, I want to make an important point. See, Sun Pharma had all the execution track record in 2008-9, and that was a company which was doing phenomenally well. Now,
Right.
who would have thought the Sun Pharma price will fall down from 1,200 rupees to 300 rupees? And they will go through all the regulatory issues which they went through, including the issues in Halol.
Yeah, so I'm coming to that. And so when you look at in terms of the US business, and probably we talk about in terms of the US FDA inspections or the regulatory issues, many a time what happens that, sometimes the media comes out and given a coverage that, okay, you have got an US for, FDA form 483 and those kind of observations. My only submission to the people out here is, and maybe the viewers, that getting a form 483 is a very, very common practices in the FDA inspection. I think what is more critical about here is how critical those observations are and how serious those observations are. Now, when we are talking about the case of Sun Pharma out here, obviously they had a pretty, I would say, the issue at Halol, which went on for 2-3 years. And that was also the time when company was preparing themselves for the next leg of growth by investing into the specialty businesses and by investing into the so-called the innovator products. So two things have happened. One, the growth engine, which primarily apart from India for Sun Pharma was the US, and there because of this lack of new approvals, the profitabilities have started coming down. The kind of price advantage which they had on the Taro portfolio between 2014 to 2016, even because of the supply side consolidations, right? Even they have taken a hit on the prices of the product, and which has impacted the kind of earnings. And as an investor, we should also be mindful that what is that driving that earning growth for the company and how sustainable that growth is. Because a very, very critical point as an investor we should look at, instead of just looking at the EPS or the profit, we should also look at the sustainability of the profit. And if we will remove our eyes from the sustainability of the profit and we give the multiple to maybe 6 months kind of an opportunity or something which is not going to sustain for the next 3 to 5 years, then probably we are inviting that disappointment for ourselves.
Sailesh, I just want to come to you at this point of time, because see, it's very easy in a hindsight to justify that this all happened and that is why the price fell. But as an investor, we are supposed to go through those emotional breakdown when it comes to money, and when we are losing so much money. A blue chip company like Sun Pharma going from 1,200 rupees to 300 rupees is not an easy task to handle. And in my mind, this is the crux of the story in investing into pharma companies, because at the end of the day, if you have to see 75% price erosion in a blue chip company like Sun Pharma, obviously there will be wariness in investors to invest money in the pharma sector. So what is your view, Sailesh? How do we face this kind of a situation, and what should we look for?
See, this kind of a situation is not unique to the pharma sector. When you have a bull market of 5 years, where you have compounding at 30-35%, and when you are valuing short-term profits by giving long-term 20, 25, 30 multiples, these risks will be there. So the criticality is a few variables which are very important to track. What percentage of their earnings are sustainable? So simply put, normally domestic and emerging market earnings are generally sustainable on a rolling 1 to 3 year basis. And they should really get the higher multiple within all the businesses which are there. We have seen that these events where prices correct by 70%, 60% normally happen after extremely high compounding of share prices which has happened. For example, the pharma sector was in a bull market from 2009 to 2015, where the businesses compounded, earnings compounded at 25%, and maybe multiples expanded further, and overall share prices compounded by about 35-40%. So the issue is it's a function of where you enter into these businesses, and overpaying for any business is dangerous. So it's more a function of having your Focus on, what kind of valuations you're paying for these businesses. The second piece is volatility is a norm, given that there are many sets of players across. If you remember in the last cycle when tech collapsed, all tech companies fell by 70-80%. The leaders also fell 70%. Similarly, when infra and all collapsed in 2008 and 9, virtually the whole market fell 50% and infra companies fell 70-80%. So ideally, it is a function of what part of the cycle we are in. Today, we are basically in a early part of the earning revival cycle in pharma. So even if you're giving them a little higher multiples than what they were getting a month back is not an issue, because earnings in the sector can double in a 4-year, 5-year period, supported by even the currency depreciation which has happened. So everything adds on to it. So when you're in a positive earnings cycle, a little bit higher multiple is not a constraint, but at peak earnings, giving peak multiples is dangerous in any sector, and likewise in the pharma sector. So it's got nothing to do with this sector having its own challenges. It's a function that because of the interest and because of significant bull market in that space, the valuations had gone awry, and entering late into the sector is, in any sector, is equally dangerous in the market. So I think it's more a function of what valuations you're paying. Early cycle, little bit higher multiples is not a constraint, and with earnings compounding at 15-18% possibility for the sector, I think
sure, fantastic.
The sector is very well positioned now.
Point beautifully made, Salish. I just want to just come to Aditya Varinder before I hand it over to you. Aditya, we discussed, yes, everyone knew that IPCA is making a loss and there are regulatory issues. What gave you the confidence that IPCA is going the Wokhard way or a Ranbaxy way, or some of the companies which did not make it up, essentially? So how do you differentiate a particular company which is going to make it and a company which is not going to make it?
Right. So two things there, Madhu. So firstly, what we did was we did an analysis of the domestic business. You have to understand first what the business which is profitable, the business which is giving you cash. You have to understand how sustainable, how sticky, what potential growth that business has. We found that IPCA has probably got one of the top 5 quality franchises in India, not by size. I'm talking about the quality of the business, the quality of the cash flow, the ROE of the business, etc. And we found that business is just going to keep growing. They are doing just the right things there. On the confidence of whether they'll be able to turn it around or not, we honestly did not know. But export business, Madhu, is a commodity business. There is no branding, right? So me, you, Manoj, we are all in export business. We are selling the same product. None of us have brands. And in such a market, what sells your product is the price. And in a price-driven market, who takes how much share and who's able to break even first and who's able to make more money is determined by his cost. Now, if you look at...
One minute, Aditya, the same thing held true for Wokhard also. That, for 7-8 years, they were in export business only, and their plant ran into such difficulty that they could not make it only.
So 2 points of differentiation there, Madhu. One, Wokhard's domestic business never passed the muster of being a good quality business.
Sure.
Second...
So you are saying the domestic business of IPCA was good enough for those prices to sustain, and the option was there if the US business works out.
Secondly, more importantly, Madhu, in the export business, when it is price that sells your product and not the brand, you need to have the right cost to have the right price. Now, in IPCA's specific case, they were a cost leader in the molecules they sold. I'll give you an example. HCQS, hydroxychloroquine sulfate. Right? When IPCA launched in the market in US, they were like this 8th or 9th player to enter the molecule. And in 2014, just before they got banned from the US, IPCA had a 80% market share in the molecule despite being the 8th or 9th entrant in the market.
Sure.
So that's cost leadership. That's what cost leadership can do to you for your market share in an export market. So we saw all the ingredients of a good quality business.
Sailesh, are we in a similar situation when it comes to Sun Pharma? Because the Sun Pharma's domestic business is so large and very, very profitable. And the point which Marinder was making, that if we compare Sun Pharma's domestic business to Abbott's domestic business, then it is available very, very cheap compared to the market cap of Sun Pharma. So are we in a similar situation vis-a-vis Sun Pharma where we were for IPCA maybe a few years back?
I would avoid commenting on specific companies directly, but I can generally tell you the construct of how a lot of these large companies have today. So let me just explain the construct of a lot of these large companies. It's and that really flows through the whole design of the pharma sector itself.
Sure.
Simply put, some of these large companies have invested between $250 million to $1 billion in specialty.
Sure.
And specialty businesses takes about 5 or 7 years to reach even some scale and promise. And I think some businesses and some companies have managed to push through because they are generating a lot of cash flows from other businesses. Now, when you look at this kind of a construct, the kind of market these companies are addressing becomes much larger, and it's a way more profitable market if you're successful. And companies making a bet, unfortunately, whatever capital allocated doesn't work out in 3 years in the stock market. It is called capital misallocation,
Sure.
right? And unfortunately, that has been a kind of a perception of investors in most businesses, that any business which is not yielded a return on equity or return on capital employed very, very quickly in a 3-year period has not demonstrated or has been not in favor for investors in the last few years. And I think that is hurting a lot of these pharma businesses. So directionally put, I think some of these bets and of investments in specialty and long-term investments are the need of the hour for these pharma businesses. If ever we have a hope to go into the top league of pharma companies, it is this decade. There are companies over the last 5-10 years now reached the scale of generating 3,000 crores to 5,000 crores of operating cash flow annually. And if they do take the right amount of risk, we have possibility that from our staple of India, you will get businesses which are in the top league globally in terms of critical therapies. In fact, I think the next 10 years, each of these businesses, the larger businesses, will make about 40 to 50,000 crore cash flows, because the domestic business will keep throwing them money. It's just about how this money is deployed, which will determine whether these companies go into the next league of from the current 10, $20 billion to 50 to 60 billion dollars. I think a lot of these companies are investing, and I think we should appreciate their investments from a point of view, because these are valued very, very well in international markets. And in Indian markets, for reasons of near-term earnings and the focus on a shorter period of time in terms of investment horizon, a lot of these businesses need, have to be, I would say, less invested than they would normally be in creating larger franchises globally. So directionally, the steps being taken on the specialty side is by most businesses is actually a good attempt. Yes, some successes initially are there, and there are a lot of failures as well. But I think under-investing and showing better EBITDA margins is not the answer for longer-term potential to be achieved in this sector. And I think companies which are demonstrating that is what we are interested in. And this kind of a kind of a framework is available across larger 4-5 large businesses in India today.
And now we are getting into the future, as we promised that we'll have a real key takeaway. So we understood the business, we understood from the experience of these guys how to ensure that the volatility in terms of valuation, like what Sailesh made a point, whenever it gets to exuberant valuation, that is the time you have to be careful about the risk which is there in the pharma sector. But whenever we are at the early cycle, like what we are today, we can afford to pay slightly higher valuation. Right? That is the only way to mitigate the risk which is there in terms of regulatory challenges which the sector faces. Now, keeping up to my promise, I want to go to Manoj and discuss, what could be the future winners? Which are the companies which we should look at if this industry has a promise from here also? So, Manoj, one name which clearly comes is Aurobindo Pharma. It has a very broad portfolio. It has significant market share in terms of generic in the US. It is basically kind of the last man standing. They have withdrawn from the large acquisition which they were making. Hence, as per the company and the management itself, they will end up paying significant portion of the debt which they have. And I know at one point of time you were very bullish on this company. Can you help us decode Aurobindo Pharma a little better and what the possibilities are over the next 2-3 years?
So to be honest, again, I would not like to be specific, from a company perspective per se.
Can you help us decode this company?
Yeah. So if you look at from the company perspective, I would say that company has really been able to scale up its franchise from a mere API manufacturers to today, I think probably one among the largest Indian generic companies in the US market.
There's approximately 10% market share in the US generic market.
Yeah, and while a part of that has come through maybe some inorganic pursuit, but when you look at in terms of the contribution what they have given to the generic industries, I think they have created a kind of model which today a lot of other companies are trying to follow. And that model is that how you can have a large chunk of portfolio, virtually a manufacturing machines coming out or developing the products at a cost which people are jealous about, and still managing the whole of the regulatory issues very, very effectively, like the kind of manufacturing facility and the number of plants which you operate. And within that, in a period where most of the Indian companies have gone through with the regulatory challenges, I think this company has been able to manage the business very, very effectively. But I would just like to point out one thing, and that's the philosophy, the way I look at the pharma sector, and the way I would like to value the pharma sector is that the companies which have consistency and predictability in profitability, and that's what I think Silas has also indicated, that the businesses which you have in India and the emerging markets, you have far more, predictability of those earnings coming over the next 1 or 3 years. And those predictability with higher return on capital employed will always get higher multiples than the businesses which are far more volatile. And to that extent, I would say that while Aurobindo on the face of it looks cheap in terms of valuations, but when you compare this company which maybe many other pharma companies or any other company in the sectors, I think a part of that valuation discount will always likely to remain.
So let me tell you, this is generally expected that Aurobindo will do around 55-60 rupees EPS over the next 2-3 years. Because I'm not getting into a quarter because of the volatility of earning. Let's say after 2 years it does 60 rupees earning. What kind of valuation PE multiple would you like to give Aurobindo given where we are in the sector, pharma sector today?
Yeah. So, Madhu, when we look at the companies, again, I think the basic focus as an investor has to be the incremental return versus the cost of investment, right? Yeah. And when you look at today, and the incremental return has to be higher than the cost of capital. So when you look at today, and looking at the base of Aurobindo where it stands, I would say that earning growth over the next 2 to 3 years are likely to be maybe high, early double digit to a mid-teen kind of a growth, given they have exposure to European market also, and they also have a large API business to them. And with those kind of earning growth, I would say the P multiple also would be anywhere somewhere in the range of around 13 to 15 times kind of range only.
Okay, that is very, very helpful. Thank you so much. And I stand corrected. In fact, their market share after the acquisition of Sandoz would have been 10%. It is much smaller. It's much smaller right now, and that acquisition did not go through. So I stand corrected. Varinder, over to you.
Well, Madhu sir, आपने बहुत question पूछे. Suppose I want to ask you one question. Okay, where will our money will be made maximum? Okay, so I will give you domestic companies, since I think Sun Pharma and Aurobindo are two names which are popping up. One segment. Second segment is APIs. We all know that you have been bullish on APIs, so whether it's Granules, Solara, or Laurels. Third is the hospitals, which are there, which Silas alluded. And fourth is the diagnostics. So if I have to break up the healthcare as per you, Madhu sir, where will the maximum money will be made for any investor, and where are you most bullish on? And please also give the names of two companies which you said which are trading below less than 10 PE.
So, Varinder, don't put me in a spot. We have spoken. We have agreed that we'll speak.
We have given full disclaimer, sir. So don't worry. Okay, so you can give.
I'm just saying, if you look at the structure of the industry since last 1 year, mid-cap companies have shown the signs of early revival and getting into a bull run very early on. It is the problem with the larger companies, which is why the sector looks like it has not done well. But if you look at mid-sized pharma companies, a lot of these companies have doubled or tripled as compared with where they were 1 year back or where they were 18 months back. So, and some of them are still trading below 10 PE multiple. Some of them, which you mentioned in terms of name, the question is now, are you looking at 2021 for the 10 PE multiple, or you are willing to look at 2022? So the way I look at it as an investor, in an era when the banks are giving you 3% return, in an era when you are made to invest in gold at 45,000 rupees, in an era wherein real estate is not making any money for you, and you are losing money in bonds. If I can identify a company which can double my money, I don't care whether it does in 18 months or 24 months or 36 months.
So just help us with the company. An example. Take example of any company which you like.
Let's say, we spoke about granules. The profit of granules was 136 crores in 2018. And the expected profit as per the management, first 9 months have already passed by. So expected profit this year will be close to 330 crores. But for COVID, it would have been 360 crores. So the company has already gone from 136 crores PAT to 350 crores PAT. Can I see that this company can make more than 500 crore rupees of PAT in the next 2 years? It is entirely possible. And if you are in my camp that it can make that PAT, then it is trading at 8 P multiple. It is not a rocket science. Similar is the story with Loris. So I'm just saying each one of us need to do our own homework in terms of what the numbers which are possible, and what is the risk which you are taking. So I am assuming that even if there is something goes wrong and the profit is 25 crore here or there or 50 crore here or there, I still have the valuation support in these companies.
No, sir. So that is very, very helpful, Manoj sir. Madhu sir, sorry. I think we are running out of time. Also, we have 5 minutes left, for the other panel. And before that, I want to ask one question to Anmol. So, Anmol, this is a question which is in everyone's mind. Should I buy pharma MNC companies in India? As I said, domestic pharma companies are not cheap. They're trading at 30-35 times, EV EBITDA. Some of the smaller companies, mid-cap pharma companies, and I think you also had a sell on Sun Pharma, I think the first one to put a sell on Sun Pharma, and that has been discussed here. So if someone has to value Sun Pharma, they say was Sun Pharma 35% domestic business. If you give EBIT valuation, then you're getting the entire 60-65% business entirely free. How should an investor like a common investor approach this? Whether go into names what Madhu sir alluded, pharma MNC, which is a great story, high ROCs but very, very expensive, or some place which can turn around like Sun Pharma or Aurobindo. Since you are a sell-side analyst and you cover everything, great to hear you.
Yeah, thanks. So I would like to make 2-3 points very quickly since we are short on time. Your co-panelists who introduced us asked us to value companies on an innovation metric, right? So on the one side, you want to look at pharma companies which innovate, which have R&D, and at the same time, we have a situation where if companies, they go into an investment cycle which doesn't produce returns for 1.5 years, we start punishing them in the market. So, Sun's case has been exactly the same, right? So while the company has tried to up its game, it's tried to create specialty products which are branded in the US, where the kind of challenges that businesses in the US have historically faced, like Aditya alluded to, that you're just competing on price. They're trying to circumvent that. It involves capital outlays. What we have seen for last 1.5-2 years is that they're making those capital outlays. As if what has happened in the process is that, that whole game of, the domestic business also getting penalized on account of investments being made in US is classically playing out. At this point of time, 8.5% of Indian market share growing, for you look at last 12 months, 20-30% faster than the market, if this had happened in an FMCG company, and it was standalone, I don't know what, if you look at some of the peers in FMCG, like levers, etc., what kind of multiples you would be giving it.
Chance of any biotech company making big from India, because that is one sector wherein there is not too much crowd which is there. Do you see a future there?
And Samsung Biologics, I think that deal happened at 55 times sales.
Yeah, which is what I'm saying. Any view on that, Sailesh?
A lot of investments have happened and we are already seeing early successes. In fact, now the path to market for biologics has become much easier than what it was even 5 years back. And we have seen 3 or 4 companies demonstrate meaningful investments now. So I think the first 5 years, the 2020 to 25 could well have biologics as an important sustainable opportunity. And we do have 3-4 businesses there which can do well.
Fantastic. Thank you, Sailesh. Thank you so much. Manoj, since we are running out of time, what will be your pick, mid-sized companies versus large companies in the pharma sector?
No, again, Madhu, as I said, and I've been repeating time and again that we are bottom-up kind of guys. And if you look at in our portfolio, we have large caps, we have mid caps. So I can highlight the top 3 holdings.
What are the top 5 holdings in your portfolio, Manoj?
Yeah, so we have Cipla, we have Ajanta Pharma, we have Dr. Lal, and we have JV Chem. So across, if you look at, we have large caps as well as mid and small caps as well.
Fantastic. Very good.
So Madhu sir, which are your top 3 holdings?
We spoke already.
Granules, Laurus.
Let us make the most out of this panel, Varinder. So one final bit of advice coming from each one of you for our investor as to, how should they look at this sector over the next 2-3 years? And is it too late to invest into pharma sector? Starting with you, Sailesh. And very briefly.
Yeah. Simply put, I think this is one of the most underappreciated and undervalued sectors in India from a longer term potential point of view. So clearly we remain bullish and we think earnings in the sector will surprise on the upside in the next 3 years, 5 years and even longer. So with that possibility, there is a great opportunity here.
Sure. Aditya?
So look for companies that have great brand value in India and good cost leadership in exports. If you're able to find companies with a match of these two, you have a winner at hand.
Good. Anmol?
I think very early in the cycle, a lot of money to be made in the sector as a whole. Surprises will be on the upside, but that doesn't mean you can't pick stocks at wrong prices and still lose money.
Sure. What about Manoj?
So we have been constructive in the past and we continue to remain constructive on the sector. We do believe that with bottom-up kind of stock selections, there's enough money to make out here.
Even if they open up the generic space and they want to put up facilities, it is not that you can start that production tomorrow morning. It is nothing to do only with capital. So, and every 4 years, whenever there is an election, whether it is outsourcing in IT or whether it is outsourcing in pharma, this team will come 6 months prior. And 6 months later, people discover, no, it is too expensive to produce.
So that is not a risk.
I am sure it will, at some point of time, it will be a risk. But at this early stage, when the valuations are in our favor, I don't think it is worth discussing or worrying about that risk. So I must say that I thoroughly enjoyed it. It was an experience to ask questions, not to always answer questions, which is what we have been used to. And I hope we could really deliver value, Varinder, and we could deliver value to thousands of people who are watching us.
So it was fantastic. Before I log off, one important disclaimer once again. I think most of the panelists, there were discussion where we had mentioned stocks. Cobgini and Bloomberg Quint, please add a disclaimer saying that all these were not at all recommendations of anything. It was just for education purpose. So please do consult your financial advisor, a big disclaimer. And second, we thought this will be for 1 hour, but it went for 1.5 hours. And I'm sure, if we wanted to continue, we could continue for 1.5 hours more, considering the kind of knowledge what these panelists have. And I really thank every one of you to be part of this panel.